Hello, everyone. Thanks for tuning in to the second episode of our newest show, The World Simplified. Every week, I will simplify some of the biggest developments in finance and economics that are reshaping our world. We are starting this show because many of you have asked us to cover global topics as well, considering the daily brief is focused only on India. So that's exactly what we're going to do every week. Now, I should have set all this context in the first episode last week, but I'll be honest, we were recording it in a hurry and forgot. Don't judge me, I'm human. So please listen to the episode and let us know your feedback about the length of the episode, the choice of the topics, and whether we are keeping things simple enough. We read every single comment you leave, and we keep tweaking all our shows based on the feedback you all give us. So with that said, I have two fascinating topics for you. The first topic is about globalization, whether it's dying and if the world is breaking up. In the second story, I look at what's happening with the green transition and the challenges that poor countries are facing. Now, in preparing for this, I've tried to read as much research and literature on the topic as possible. We have included all the links in the newsletter that we send out, along with the show, in case you want to deep dive on something. The link to our newsletter is in the description. So let's now dive deep and try to simplify a topic that's been a big part of the economic conversations in the last decade or so: globalization. If you've been paying attention to the news headlines over the last decade, you've probably heard some variation of this pronouncement. Globalization is dead. It started during the 2008 financial crisis when countries began looking inward. We heard it again when COVID-19 hit in 2020, throwing global supply chains into chaos. The narrative gained momentum with Russia's invasion of Ukraine in 2022, disrupting critical resources and global stability. Then there's the ongoing US-China rivalry, driving talk of nearshoring and friendshoring, where nations prefer trading within their own ideological blocks. The narrative seemed obvious. Globalization had gone too far, and now it's dying slowly. But before I do a deep dive, let me quickly give you a brief history of globalization. To understand where we are today, let's rewind. Globalization is about interconnectedness, the flow of goods, services, capital ideas, and people across borders. Historians talk about various waves of globalization. The first wave began with the Silk Road between 130 BCE to the 1450s, an extensive trade network connecting China, Central Asia, and Europe. It facilitated not just the exchange of goods like silk and spices, but also cultural and technological exchanges across regions. Following the Silk Road came the Age of Empire, which was between the 1500s and the 1900s, when European colonial powers expanded their territories, creating networks of trade that spanned continents. This early form of globalization laid the groundwork for the interconnected global economy that we see today. The 19th century saw another wave, driven by steamships, railroads, telegraphs, and the Industrial Revolution. These advancements allowed Europe and North America to exchange goods and information faster, further expanding global trade. The second wave of globalization came after World War II, from 1945 to the 1970s, with institutions like the International Monetary Fund or the IMF and the World Bank shaping an interconnected global economy. These Bretton Woods institutions laid the foundation for global recovery and development. This phase evolved into a market-oriented system in the 1990s, paving the way for hyper-globalization. This wave also set the stage for what historian Kenneth Pomeranz termed the Great Divergence, where Western countries experienced significant economic growth, while many other regions lagged behind. The divergence highlighted growing disparities, driven by concentrated industrial production in a few regions. In contrast, the later Great Convergence marked a period when emerging economies began catching up with the West, facilitated by increased trade, investment, and technological advancements. The third wave of globalization began in 1980s and 90s, influenced by the shift from fixed to floating exchange rates in 1973, which led to increased global integration. This is what Professor of Economics Maurice Obstfeld called the second great globalization, driven by technology, satellites, the internet, and economic liberalization, particularly in China and the developing world. The ICT, short for Information and Communication Technology Revolution, fundamentally transformed globalization. The rise of personal computers, the internet, and telecommunication advancements made it possible for companies to break down production processes and move each stage to locations with the most cost-effective resources. For example, a company might design a product in the United States, manufacture components in China, assemble them in Mexico, and sell the final product globally. This led to the creation of global value chains. A notable example is the iPhone, which is designed in the United States, sources components from multiple countries such as Japan and South Korea, assembles them in China and India, and sells the final product worldwide, taking advantage of specialized expertise and cost efficiencies at each stage. Now, the hyper-globalization phase, shaped by the collapse of the Soviet Union, European integration, and China's emergence as a global power, led to the rapid trade and financial integration. The establishment of the WTO in 1995 and trade liberalization accelerated global trade and cross-border investments. This phase marked the Great Convergence, where developing countries began catching up with developed economies by integrating into global value chains. Advances in ICT and the liberalization of trade policies fueled this process. Baldwin describes this era as one of unbundling production processes, allowing companies to split supply chains across multiple countries, maximizing efficiency while reducing costs. However, globalization hasn't been without backlash. On one hand, it lifted millions out of poverty and industrialized developing countries, but it also had its downsides. Jobs moved overseas, and manufacturing towns in developed countries suffered. Wages stagnated and inequality widened. The 2008 financial crisis highlighted these inequalities. Politically, this led to populism and nationalism. With COVID-19 and rising geopolitical tensions, people began questioning whether globalization was worth it if it made economies vulnerable. The globalization backlash has been well documented. Researchers noted a shift in electorates across advanced democracies towards protectionism. This wasn't solely due to trade, but also driven by technological change, fiscal austerity, immigration, and cultural concerns. Historian Adam Tooze highlights how these factors created societal cleavages, fueling anti-globalization movements. Tooze also emphasizes the uneven impact of globalization, often referred to as the elephant curve of global income growth, which shows that while the middle class in emerging economies experience significant income growth, the working and the lower middle classes in advanced economies saw stagnation. This imbalance fueled populist politics and anti-globalization sentiments. Despite these challenges, the idea that globalization is dead is an exaggeration. Richard Baldwin, Brad Setzer, Arvind Subramaniam, and others argue that we are seeing a transformation, not deglobalization. Take the trade in goods for instance. There has been a slowdown, but the world trade hasn't collapsed. It's shifted. Countries are diversifying supply chains. Services trade, on the other hand, is booming. Digitalization has led to a surge in the trade of services, everything from consulting to digital content. Baldwin describes this as a shift towards a digital, service-oriented form of globalization, driven by technological changes and the rise of globotics, a mix of globalization and automation. Economist Brad Setzer also notes that despite geopolitical tensions, Chinese exports have remained robust. Between 2019 and 2023, China's exports increased significantly, driven by competitive pricing on high-tech goods. Tariffs imposed by the US did not sever ties but led to rerouting through countries like Vietnam and Mexico, reflecting the resilience of global trade. Richard Baldwin, a professor of international economics, in his series The Peak Globalization Myth, argues that while the ratio of goods trade to GDP has declined, globalization is evolving. The growth in services trade underscores that globalization is transforming, not retreating. The interconnectedness of services, data flows, and intermediate goods continue to grow. Building on this theme of transformation, recent research by the Bank for International Settlement, that is BIS, dives deeper into how geopolitical factors are influencing global trade patterns. In case you didn't know, the BIS acts as a bank for central banks, and their mission is to support central banks' pursuit of monetary and financial stability through international cooperation. Now, the BIS research paper titled Deconstructing Global Trade, the Role of Geopolitical Alignment, shows that geopolitical forces are reshaping globalization. Trade is increasingly influenced by political alignment, with countries trading more with allies and less with rivals. This isn't just about US and China, it's a global phenomenon. The EU stance on Russia and China's role in Asia illustrate how trade is shifting based on political calculations. Geeta Gopinath, the first deputy managing director of the IMF, refers to this shift as blockalization. Countries are forming tighter economic ties within friendly blocs. The trading system is fragmenting into distinct blocs such as US-led bloc, a China-centered bloc, and a Russia-oriented bloc. This fragmentation leads to increased trade among allies while reducing dependencies on rivals. The IMF paper titled Geo-Economic Fragmentation and the Future of Multilateralism highlights the risk of fragmentation, including reduced integration, capital flows, and technology diffusion, potentially leading to a global GDP loss of 1.5%. The CEPR paper titled Geo-Economic Fragmentation, the Economic Risks from a Fractured World Economy, emphasizes that output losses could range from 0.2% to 6.9%, with severe scenarios reaching 12% for some countries, particularly if technological decoupling is included. This isn't a death knell for globalization, but a critical change in its structure. Fragmentation risks increasing trade inefficiencies and costs, but may also add resilience by reducing dependence on single trade partners. Globalization has evolved through multiple phases, and each phase has brought opportunities and challenges. While we are seeing fragmentation and shifting alliances, it's clear that globalization is not dead. It's transforming. Now let's talk about the global energy transition, along with its challenges and investments. We'll cover three main themes: why we need renewables, how the transition is going, and the reality behind investments being made or not being made in different parts of the world. Let's look at the progress, the gaps, and the challenges still ahead. Let's start with the temperature target set at COP28. COP28 is a major climate summit where world leaders meet to discuss and set climate action goals. Following COP28, nearly 200 countries agreed to limit global warming to well below 2 degrees Celsius, with an effort to keep it to 1.5 degrees Celsius by 2050. This target is essential to prevent the most severe impacts of climate change, such as extreme weather events, sea level rise, and disruptions to agriculture and water supply. In 2023, global temperatures hit record highs, temporarily crossing the 1.5 degrees Celsius mark. Climate scientist Zeke Hausfather, in his analysis for Carbon Brief, showed that the world is warming faster than expected, raising concerns about when we might permanently cross the 1.5 degrees Celsius limit. Reaching 1.5 degrees Celsius for a year or two doesn't mean we've crossed the threshold permanently, but it serves as a serious warning. It shows us what lies ahead if emissions aren't reduced quickly. Carbon Brief's projections suggest we could permanently cross the 1.5 degrees Celsius limit as soon as 2030 or even by 2028. The urgency is clear. These rising temperatures are not a distant threat. They are happening now. The longer we delay, the harder it gets to avoid the worst effects of climate change. This isn't just a buzzword for activists. The world is at a critical point. Nearly 200 countries agreed to triple renewable energy capacity by 2030, which means adding significantly more solar, wind, and other clean energy sources to replace fossil fuels. This is a huge commitment, and it's not about protecting the environment. It's about the survival for economies and people. About 50% of the emissions reductions needed to limit warming rely on expanding renewable energy. Solar, wind, and hydropower are essential if we are to meet climate goals and maintain a functioning global economy. The need is urgent, and the time is running out. The short answer: not fast enough. Solar installations are breaking records. 593 gigawatts are projected to be installed in 2024, according to the International Energy Agency, or the IEA. This is a major boost, equivalent to powering hundreds of millions of homes with clean energy. Despite this growth, Bloomberg NEF reports that the world will still be 29% below the net zero pathway by 2030. To meet the net zero target, capacity would need to increase by an additional 13%. The IES data help us understand where we are in this transition. According to Bloomberg, even with this growth, the renewable energy market isn't expanding quickly enough to meet the 2030 targets, which means we risk falling behind on our climate goals. Much of the growth is in a few regions: China, the United States, India, and parts of Europe. On the surface, it might look like we are making big progress, but it's more complicated than that. Where is the growth happening? Well, mostly in advanced economies and China. China alone is adding 28% more solar capacity this year and accounts for over half of global solar installations. The US, India, and Germany are also making big strides. It looks like the green transition is gaining momentum, but we're still not on track to meet the 2030 goals. If we continue at the current pace, we'll fall about 29% short of what's needed to stay on a net zero path. Net zero means balancing emissions produced with emissions removed to bring overall emissions to zero. And this is despite major investments. According to Bloomberg, the world needs to invest around $1 trillion per year in renewable energy from 2024 to 2030, plus another $193 billion annually in battery storage and $607 billion for the grid. The grid is the infrastructure that delivers electricity, including power lines and substations. The needed investment is much higher than what we are currently spending. According to the IEA, in 2024, global investments in clean energy is expected to surpass $2 trillion for the first time, outpacing fossil fuels. That sounds great, but here's the catch. 85% of these investments are in China and advanced economies like the US and Europe. Emerging and developing economies, that is EMDEs, outside of China get only 15% of the global clean energy investment, even though they make up 2/3 of the world's population. If we want real progress, we need more capital flowing to these developing countries. They're facing the fastest energy demand growth and are on the front lines of climate crisis. But we can't ignore the ongoing investments in oil. According to the latest IEA report, investments in oil and gas remain high, with only a small portion redirected towards renewables. In fact, the IEA reports that just 4% of industry spending is on clean energy, while 96% goes to fossil fuels. Although some companies are investing in renewables, it's still a small fraction of their total spending. In 2024 alone, oil investments are projected to exceed $500 billion. Then there's also the issue of stranded assets. Oil and gas projects that might become unprofitable as the world transitions to green energy. Despite growing renewable investments, continued spending on fossil fuels could make it much harder to achieve climate goals. Now quickly let's talk about the cost of financing for emerging economies. The cost of financing a solar project in an emerging economy can be more than double what it costs in countries like Germany or the US, largely due to higher interest rates and economic risks. For instance, the weighted average cost of capital for solar projects in countries like Mexico and South Africa is approximately twice that of advanced economies, with bond interest rates around 9 to 10% compared to 3% for US bonds. The cost of capital is the average cost of obtaining funds for a project, including both equity and debt. In countries like Mexico and South Africa, the cost of capital for solar projects is around twice that of advanced economies, making it harder for these nations to expand renewable energy. One major reason for this high cost is the dominance of the US dollar in international finance, which means many emerging economies have to borrow in dollars. This makes them vulnerable to changes in US interest rates, as political economist Daniel Driscoll explains. Many emerging economies need dollar-denominated funding, which makes them vulnerable to the US monetary policy. This increases their risk and the cost of capital. US interest rates also play a big role. When the Federal Reserve raises rates, dollar loans get more expensive, further increasing costs for emerging economies. Even though the US cut rates this month, interest rates are unlikely to drop to zero due to the spending needed for the green transition, climate mitigation, and adaptation. This means inflation is likely to stay higher, and even as renewable technology gets cheaper, financing costs stay high, keeping many nations from making significant progress. Financing costs make up the biggest share of clean energy project costs in these regions, often accounting for half or more of the levelized cost of electricity for utility-scale solar PV projects. This means these countries end up paying more, or worse, can't get projects off the ground. In India, for instance, financing costs for utility-scale solar PV projects are still more than double those in advanced economies like Europe, despite competitive capital cost. Solar and wind projects can be too expensive upfront, pushing these economies to stick with more polluting options like coal. Reducing the cost of capital by just 1 percentage point could save an estimated $150 billion in clean energy financing costs annually from 2024 to 2015 in emerging economies, making a significant difference in their ability to transition to renewable energy. Now let's talk about how some institutions and wealthy countries are trying to address the high cost of capital with a strategy known as de-risking model. Daniela Gabor, a prominent economist, has extensively analyzed the de-risking approach. Wealthy countries, development banks, and international institutions are promoting this strategy. In simple terms, this means that governments and public institutions absorb some of the financial risk of green projects to make them more attractive to private investors. The goal is to make these risky projects look safer so that investors feel comfortable putting in their money. Imagine a risky green project as a shaky bridge. Instead of expecting private investors to cross it on their own, the government steps in to reinforce the bridge, making it stable enough for investors to feel safe. The problem is the government ends up carrying most of the risk, which means taxpayers are ultimately responsible. The issue with de-risking is that it often means the public sector, funded by taxpayers, takes on the majority of the risk, while private investors get the profits with minimal risk. This is often described as socializing losses and privatizing gains, where the public covers any potential losses, but the profit goes to the private investors. Another downside is that de-risking tends to favor the safest, most profitable projects, often ignoring those that are riskier but essential for fair climate progress. These riskier projects, especially in vulnerable communities that need green solutions the most, get left behind. De-risking doesn't solve the underlying issue of high financing costs in developing countries. It just offers a temporary workaround. Gabor's research highlights how de-risking impacts public finance and the role of private investors. She argues that while de-risking helps attract private capital, it also shifts risk onto the public sector, potentially limiting a government's ability to invest in other critical areas. Moreover, Gabor points out that focusing on de-risking can lead to an over-reliance on financial markets, which may not always align with the social or environmental policies. So let me bring it all together. The green transition is happening, but it's not happening evenly or urgently enough. Advanced economies and China are leading the charge, investing heavily and breaking records in solar and wind projects. But emerging economies are struggling with high financing costs, and even with de-risking efforts, the playing field is far from level. To succeed in this transition, if we want to meet climate goals and make renewable energy a global solution, we need to significantly boost investments and ensure that funding reaches developing countries that need it the most. The systems we have in place are making progress, but it needs to be faster, deeper, and fairer. Thank you so much for listening. I hope you liked our experimental episode, and once again, please share your feedback in the comment section.